Okay, so now we're going to look at an example where we don't sell it in the year we decide to discontinue. Okay, so if we're holding something for sale, but we are unable to sell it, right, by the end of the accounting period, then we absolutely have to check for impairment. Okay. And impairment essentially is a way to check whether the book value that we have this asset we're holding for sale, right? The amount that it's listed at on the balance sheet is an overstatement of how much we could sell it for. So if the book value overstates, right? If we have something listed on our balance sheet at a price that is more than what we could get in a sale, then we have to impair. So an impairment loss occurs when the fair value of net assets, so this is the sale price of all assets minus the sale price of all liabilities. So the amount I could get for all the assets added together, subtract off the amount that I would be able to sell all the liabilities for. And then we subtract off any cost to sell, right? So we subtract the sell price of assets less the sell price of liabilities. And then we also reduce that by any cost to sell. So if that price, if this is less than the book value, then we impair. So we look at this amount, we look at the amount of the book value, and if the book value is greater, then we reduce the book value down to this amount. Right? We never do the opposite, right? We never take, if the sell price, if this is greater than the book value, we do not bring the book value up to this price. We only bring it down. That's an example of some conservatism. So let's look at another example, not Rocky anymore, but more in the sort of Roman mythology piece. Helion decided in 20x6 to dispose of Bacchus, a qualifying component. During 20x6, Bacchus had a pre-tax loss of 40,000. Okay, so make sure you keep track of pre-tax versus post-tax. Bacchus is the component we are deciding to get rid of. It had a pre-tax loss of 40,000. On December 31st, the book value of Bacchus's net assets, and again, important to know whether we're talking about what I find on the financial statement versus sell price. The book value of Bacchus's net assets was 200,000. The fair value less cost to sell is 130. Notice also, I'm telling you, they're net assets. So I'm not giving you assets and liabilities separate. I'm combining them. You got to be able to move, whether I tell you assets and liabilities separately, net assets, know what those things mean. Got to be fluent in this language. So keep practicing it, keep learning these terms. The fair value, less cost to sell. So I've done all of that for you, is $130,000. If Helion is unable to dispose of Bacchus by the end of the year, then let's record the appropriate disclosure and assume a 40% tax rate. Income from continuing operations is 370. So nothing changes about this disclosure from what we did before in terms of how it's laid out. The only thing that's different this time is they were not able to sell it. We do not have a gain or loss on sale. Because we were unable to sell it, we have to check for impairment. So we start with income from continuing operations. And that is 370,000. And we are going to now move through this discontinued disclosure. Always, whether we sell it or not, we have to consider what the operations of the discontinued division provided. In this case, their net income or net loss. Well, we have a pre-tax loss of 40,000. So the disc op pre-tax loss was 40,000. And remember, it's a loss, so we don't have additional expense for tax. Rather, we get a reduction on the loss from that tax effect. So 40% of 40,000 is 16. This is my tax provision, not my tax expense. It's reducing the loss. So this is my loss still, but it's the loss that is net. So I can now write this through. Loss from disc ops, net of tax. The tax that I'm netting in this case is the 16,000. And the amount that's remaining is $24,000 of a loss. Now we deal with the impairment piece. Remember, we're looking at the book value of net assets, which in this case, 200,000. And we're comparing that to the fair value of net assets less cost to sell. In this case is 130. So remember, we want to be conservative in accounting. I have this currently recorded on my balance sheet at 200,000. All of their assets minus all of their liabilities, those book values give me 200,000. But when I look at what I could sell all those assets and liabilities for, and the cost to sell all of that, it's 130,000. So this is overstating the amount I could sell it for. It's almost like we're doing a reality check, right? We're saying we're not waiting to sell it to figure out the gain or loss. If there is going to be a loss because I could only sell it for this amount after I consider cost to sell, then go ahead and reduce this amount now. So I'm going to record a loss from impairment because the book value overstated the fair value less cost to sell. And always remember to write net of tax, because that is a required disclosure so that people know that was taken out. So to get this down to that, I need 70,000. That would be the gross impairment. It is a loss, always a loss, right? Because we're bringing the value of things on our balance sheet down. It is a loss, but it's now not net of tax. We need a net tax from it. So we take 40% of 70, which is 28. This is my tax provision. Reduces that overall loss. Now it's a $42,000 loss. So we netted tax of 28,000. That was our tax effect. And we get a $42,000 loss. If we bring these together, add them up, and I'll put the zeros back on since I did over here, right? So this is in total now, the loss on operations of 24 and the loss on impairment now brings me up to 66,000. This is the total effect of our discontinued operations. And I take that from 370. That becomes my net income. All right. So that's the year we didn't sell. Now let's fast forward into the next period. Same company. They're still trying to sell this guy. On 20X7, Hillian had a net loss from operations of Bacchus. So Bacchus still is losing money. It's their discontinued division, but they managed to sell it on May 17th. That loss from Bacchus was 8,000. On May 17th, Hellion sold Bacchus for $150,000. Complete the discontinued operations for the income statement, assuming the income from continuing was that. So we have our two pieces now. Remember, we're going back to that prior example. If we sold it, there's still this net loss of operations from Bacchus, 8,000. This is a net loss. I didn't say this is a pre-tax loss, it's net, so it already has taxes taken out. And the sale price. So let's start. We always start with the income from continuing operations. So what did Hellion make? Income from continuing ops of $390,000. And if this is that piece, right? We got taxes out of this. Now let's talk about what happens here. We got to record the loss first. And it was a net loss. So we just say loss from discontinued ops, net of tax. That's the net tax amount, 8,000. Now, to get that tax amount, remember, first we got to gross this up because this is net. We got to get back to the gross amount, the full amount, 8,000 divided by, and what is 8,000? What percent of the total was 8,000? It is 60% because we took 40% off of it. And so if I divide 8,000 by that, I get that the full amount was 13,333, repeating many, 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 many times. So this was the loss before tax. And now I would take off the 40%. That would be my tax provision of this amount, which is 5,333, which gives me that net loss. Okay. Important, not just for my class, but that's a life skill. You learn how to gross up discounts, right? So that net tax would be 5,333 net of tax of that amount, right? So we got that piece done. Now we have that gain or loss on disposal thing. So we got to consider they sold Bacchus for $150,000. So what did I get? What I got was $150,000. And that's cash, right? What I gave up. I gave up my discontinued division. And so if I gave up the book value of these assets, no. Problem is, not the problem, but you got to be observant. The book value was 200,000. But after I recognize this impairment loss, this is an accounting item. This has become a loss account. Not only is it a debit to this loss, but it also credited this 200,000. So that now the book value of net assets is 130. Just to kind of see that perhaps a little more clearly, this is a bit of a simplification of the journal entry, but it works. We would have recorded impairment loss of 70,000. And we would have credited because there's no such account as the book value of net assets of the disc op. This is the simplification part. This is spot on, but we credited that value. So if again, we simplify just a little bit and say, hey, here's this T account with the book value of net assets of the discontinued division, blah, blah, blah. Don't have enough room for that. It started at 200,000, but I just credited it for 70,000 at the end of the last year. So this is the new value of the book value of my net assets. So I gave that up. Just to add to, if I had those selling costs, if I had selling costs for this, right, I would have to subtract this off as well. So that would be part of what I gave up is selling costs. So I would have to consider that not only did I give up 130 in net assets, but I also had to pay, let's say, $20,000. Well, then I gave up 150 total. So then I wouldn't even have a gain or loss because it'd be 150 minus 150. But in this case, I don't mention these selling costs when I actually sold it. Now I just have 20,000. This is my pre-tax gain. And it's a gain because I got more than I gave up. It's a positive amount. If I gave up more than I got, I have a loss. But it's pre-tax, take the tax rate, 8,000. This is my tax expense on that gain, which means that the gain is going to be 20 minus 8 or 12,000. This is the gain on disposal. Net of tax. What is the tax that I've netted? This amount is 8,000. Right. Now, this is a gain. This is a loss. Make sure you don't screw them up like I have been today. 8,000 negative plus 12,000 lands me in a realm of 4,000 positive. The total effect from the disc ops this year after I sold it, then my net income here is $394,000. Right. So that would be the complete disclosure for the year sell. And you just have to keep in mind that if I impair in the prior year, the book value of net assets is no longer what it was prior to impairment.